Thank you for joining us today for Jennifer Schaus and Associates in our Webinar Wednesday program, coming to you live from Washington, D.C. We are uncovering each part of the DFARS, or Defense Federal Acquisition Regulation Supplement, every Wednesday at 12 p.m. Eastern. And as you know, the DFARS are the rulebooks for contracting with the Defense Department, and we have been moving sequentially. So we started with DFARS Part 201 in January, and we will be finishing with Part 253 in December. Our webinars are every Wednesday and are provided complimentary. They are recorded and can be downloaded from our website and YouTube channel, which now holds over 450 of our government contracting webinars. In the interest of time, we do not take questions, so if you do have questions for our speakers, we will have their information on the last slide of the presentation today. Virginia PTAC at JMU offers free one-on-one counseling to firms in Virginia on federal, state, and local procurement topics. Online resources and group trainings are free with no restriction on business location. If you are interested in learning more, please use the links provided to explore what PTACs can offer. Set-Aside Alert provides up-to-date news, information, and opportunities for small business federal contractors. Their daily opportunities alerts assure you won't miss important sources, sought, and solicitation announcements, providing details so you can jump on the hot ones. And every 2 weeks, they deliver concise breaking news, events, regulations, and teaming opportunities. Please join the Reston Chamber of Commerce Government Contractors Council for regular meetings. And you can contact Alicia Fields with the email shown on your screen if you do have any questions. Federal contracting is a relationship game. Now get in front of your federal humans sooner with the exclusive Players and Layers method from Judy Bratt and Summit Insight. Connect with her on LinkedIn and find out more, or visit GrowFedbizcom today. If you are interested in selling to the federal government, you may need a contract vehicle. The most popular one is the GSA Schedule. Learn more about the requirements, the proposal process, and how this contract vehicle may or may not be the right tool for you. Jennifer Schaus is teaching a series of classes, as you can see here, the next one being tomorrow. And all classes are listed on our website under the events section with the registration link. Okay, and now a little bit about us. We work with U.S. federal government contractors, including product, service, and software firms. Our services range from market analysis reports to contract vehicles and compliance, and more information can be found on our website. We also have opportunities for your organization to advertise in our newsletter. We now reach over 23,000 subscribers, and this includes both contractors and government. You can contact us for pricing information with the email shown on your screen. And I also wanted to inform you of a new series that we're holding this year. We have launched a monthly series called the GovCon Live Q&A Cafe. And this is a live webinar series held each month. And these will take place on the second Friday of each month this year in 2021 at 12 p.m. Eastern. We have assembled a group of 4 panelists who are subject matter experts on a specific federal contracting topic. And these panelists will make a short presentation about the topic listed here on your screen, and then take your live questions about that topic. So for example, our panelists covered sales and capture this month, and next week on July 9th, our panelists will be covering proposal writing. Our panelists include attorneys, consultants, and other industry professionals, and you can sign up on our website under the Q&A Cafe tab, and sponsorships are available for this series. And please email hello@jenniferschaus.com for a media kit with pricing details. Also, please note that you can use code DFARS for a $15 discount on each of these webinars. Okay, and now to introduce our speakers. First, Josh Estamati, and next Susan Eckles. Welcome, Josh and Susan. We're glad to have you here with us today, and I'll now turn the floor over to you.
Hey, thanks so much, Hunter. I appreciate the introduction. My name's Josh Idamati. I'm with District Bonding right here in Northern Virginia, just outside of Washington, D.C. Just a brief intro to myself. I've been in the business about 15 years. I went through 2 different acquisitions at 2 other agencies and figured, hey, I better do this myself. So I started this company earlier this year, and I look forward to talking to you today.
And good afternoon. Thank you for having me. My name is Susan Eckles. I'm a special counsel in the Baton Rouge office of Adams and Reese. My practice primarily consists of construction and procurement work. And in the construction arena, I've represented sureties, general contractors, subcontractors, and owners. And on the procurement side, have worked in both the federal and state procurement arenas. So thanks again for inviting me to present today.
We can go to the next one. Yeah, thank you. And so we're going to be talking about bonds and insurance today. Hopefully, Susan and I will just have a little good back and forth dialogue about the different types of bonds, as well as kind of some of the steps necessary to become bondable, a little bit about the definition of bonds, and we'll talk a little bit about insurance as well. We can go to the next slide. So if you look at the DFARS Part 228 and you read it, it reads a lot like the FAR Part 28, which talks about performance and payment bond requirements for contractors that are performing construction work. This one is worded pretty similarly to what's in the FAR. It does say, for cost reimbursement contracts, it's waived. But for any cost type contract over $40,000, it requires, actually the prime contractor to obtain from each of their subcontractors the appropriate performance and payment bond protections, which we'll discuss on the next slide. So the first part says, for any contract over or any subcontract over $40,000, but not exceeding $150,000, there are options available for various payment protections. And if you look at the FAR Part 28, you'll have things like bonds or notes, a letter of credit, a cashier's check, and even an escrow agreement would be an option as well for those contracts between $40,000 and $150,000. But for most of the contracts that we're seeing being bonded are over $150,000. And there's 2 requirements. There's the payment bond, which says that, they'll pay the labor and material costs, and then the performance bond, which I'll talk about, in a little bit more detail, but, basically states that the work will be performed. Next slide. There's also reference to the Defense Environmental Restoration Program, construction contracts, I guess also known as Superfund. We don't run into this too often, but it kind of outlines the rights of action under these performance bonds, and I know Susan will be kind of talking about it as well. So it talks about the surety's liability, which is kind of limited to really the cost of the completion of the contract work, not, anything outside of that. Next slide. And that continues as well, which I know Susan will highlight a little bit too. But that, the surety is not liable for any indemnification or compensation of the obligee, which is basically a fancy word for owner. We'll talk about the definitions of bonds as well, but that the surety is not liable for compensation or indemnification from personal injury or property damage, even if the damage was caused by a breach of the contract. And then once the surety has taken action to meet their obligations, they're then entitled to indemnification and reimbursement at that point. Next slide. There's also other types of bonds as well. Again, we don't see these too often. Fidelity bonds are kind of like a we call them a business services bond or a dishonesty bond. It's kind of like a crime policy. So if you're, if you see the trucks on the sides of the road that say licensed, bonded, and insured, usually they're talking about a fidelity bond, which basically says if they're working in someone's home or in someone's office, that if something gets stolen, there's protection should they be convicted of, theft, essentially. But it's, as you can see, it's saying it's generally not required, but it's authorized for use when it's necessary to protect the government or the contractor, or they require the investigative and claims services of a surety company. Next slide. And so the DFARS doesn't specifically mention bid bonds, but it is an important part of the bonding process. So I thought I would include that in here. Bid bonds are very similar if you've ever bought a home before, kind of like an earnest money deposit. So basically, it's kind of like a pre-qualification, if you will, with a penalty. So if you're the federal government, you'll require a bid bond to bid a project, and typically that guarantee for the federal government is 20%. And so when a contractor or a subcontractor contacts a surety company, they're going to be doing the evaluation and the pre-qualification for the full contract amount, assuming that if the contractor is awarded the contract, that they will be required to provide the performance and payment bonds. So even though the percentage is less, the underwriting is basically the same. The performance bond is part of the DFARS requirement. This says that you will complete the work according to the contract, the scope, the completion time, the warranty period, and usually almost all the time, it's 100% of contract value. So what bond companies are going to be typically looking for in the contract is kind of, it's mentioned here, but they want to know that it's not too long of a term, or, if it is a long term, that you've got the capabilities to handle the completion time. They'll look for, any extended warranty provisions. They'll look for liquidated damages clauses in the contract, to see that if you do run into an issue, that you're still going to be there to finish it, and that there'll be enough money to finish it. And then there's the payment bond. And the payment bond says that you'll pay your subs, suppliers, and vendors. And that also includes, in some cases, second tier subs as well. So, if a subcontractor is providing to the prime contractor a payment guarantee via a payment bond, that bond is also saying that their subs and suppliers are paying their bills. So when we're, looking to bond a contractor, we're starting to coach them on vetting out their subcontractors and vendors as well. Next slide. And so if a contractor were to contact a bonding agent, and they say, well, what do I really need to get started? We say kind of, three things to get started is number one, contact a bonding agent that, specializes in construction, that understands bonds. There's a lot of really good insurance agents out there that kind of, dabble in bonds. So they might have one market or two markets that they can go to, but they may not have the expertise of a, surety bond only bond agent. So, talk with the bonding agent. Now it doesn't, cost anything to get pre-qualified, to get an idea of what you might qualify for. So that's, step one. Step two is find a construction-oriented CPA. Again, there's a lot of really good accountants, a lot of really good, tax accountants out there that will tell you to, buy a bunch of equipment at the end of the year and, take all your money out and show a loss. And, that's great for tax purposes. But when you're going and asking a bonding company for support, they're going to say, well, you didn't make any money. So a good construction-oriented CPA, they understand the balance between taxes and bond capacity, and they can kind of help you find the balance that works best for you. Plus, there's also ways that they calculate working capital and how they build your financial presentation to make you more bondable versus just a regular tax accountant. And then third, check your company credit and also check your personal credit. There actually are bond programs out there that are based entirely on personal credit. So if you've got a decent credit score, you can get a bond up to $500, to $750,000, depending on credit score. Now that's not the only option if you don't have great credit, but if you do have mistakes and you do have issues on your credit score, you want to make sure you get them fixed and corrected. You can go to annualcreditreport.com. That's through FTC, and you can actually get a copy every single year. So I would recommend doing that, so you can get any of those mistakes fixed and corrected. Next slide. And so, kind of the next step is, well, what are you guys looking at? What are bond companies looking for when they're looking to bond somebody? We always say the 3 C's: character, capacity, and capital. Character being your reputation, your resume, your credit, your history. So we'll, ask for, resumes. If you have a business plan, we ask for that. We ask for, we do run credit, personal and corporate, letters of recommendation, things like that go a long way towards establishing character. Next is capacity. So I always use the example of if you've, painted walls, and now you want to paint bridges, it is painting, but it is very different, right? So we look at the prior work that's been completed. We look at what you've done and what you're wanting to accomplish. So we, ask for job references. We talk through the project with you to get kind of an understanding of this job compared to, previous work. And then capital. Obviously, cash is king. Having money is, they always say, it takes money to make money, but we do look at financial statements, your work on hand schedule. We do look at corporate and personal financial statements when you're looking to just get started for bonding. But, that's a big part of the process. Now, a lot of people ask me, like, do you need an audit? Do you need a review? Do I really need a CPA statement to get a bond? And the answer is no. If like I said earlier, if the job's under $500,000, you've got good credit, we can get you a bond there. But if the job is $1.5 to $2 million, you can generally get away with a really good quality internal financial statement. So, QuickBooks, spreadsheets, things like that can go a long way towards establishing and building bonding capacity. Next slide. And then, how much does it cost? Bid bonds don't cost anything. The only thing that you need to keep in mind if you're bidding a job is to include the cost of the bond in your proposal. So even though the bid bond has no cost, when you're submitting your proposal to the prime contractor or to the government, that you include the cost of that bond in there, because that's a reimbursable job cost. And then the performance and payment bonds will run between 0.5% to about 3% of the contract price. Now, those credit-based bond programs that I was talking about are going to run on the higher end, 2.5% to 3%, and most of those smaller contractor type programs are going to be on the higher end. But as you grow and as you get bigger, working with your bonding company and with your bonding agent to obtain your goals, if you will. If your goals are to reduce your rate, there's things you can do to do that. If your goals are to increase capacity, there's things you can do there. And then, which we'll even highlight a little bit later, if you're talking about your personal indemnity, you want to get off personal guarantees. There's options as well there. Next slide. And so I'll start to pass the torch on over here to Susan, who can talk a little bit more about the terms of surety, and we'll go from there.
Thank you. So oftentimes when we have an owner or a subcontractor and they're looking at the surety bond, they don't understand what the terms mean, and it is a foreign language to a lot of people. So when you're delving into a bond, you need to look at the relationships, because the relationships in surety are critical. So first we have the principal, And that's the party that's bound on the bond. That's the party that's obtaining the bond. So they are the contractor or the subcontractor on the project. They are the one that is being bonded. The obligee, that is the government or the owner. They are the party for whose benefit the bond is being issued. They're the party who's being protected. And you have the surety, that is the company that's issuing the bid, payment, or performance bonds. And Josh mentioned the general agreement of indemnity and indemnity requirements. Well, every surety bond has a general agreement of indemnity, and that agreement is signed either by the business if you have very good credit and assets and you have that past performance of significant number of years, or the owner's members, family members in some cases, if there aren't a significant number of performance years and there isn't good credit and there aren't a lot of funds on hand. And what that general agreement of indemnity does is allows the surety to step in the place of the principal, of the contractor, and do what the surety needs to do to get the project on track, to resolve a claim from the owner, the government, or a subcontractor, get the party paid, and at the end of the day, the surety is going to come back to the principal for any funds the surety expends. And the surety has the right to do that under the general agreement of indemnity. So if a claim is made on the bond and the surety has to investigate the claim, so the surety hires experts, the surety brings in legal counsel, the surety ends up paying a payment bond claim, then the surety is going to come back to the contractor and provide them with a listing of what was expended and how those funds were expended, and will say, okay, now what is your plan for making payment to me? And often the general agreement of indemnity requires posting of collateral and also allows for the surety to settle matters on behalf of the contractor. Next slide. Oh, and one other thing I want to touch on with the GAI, the General Agreement of Indemnity, is as was mentioned earlier, when the company is starting up, it may be that every member or even additional family members are signed up as indemnitors. So, Josh, how often would you recommend that a company visit with you in order, or another agent to go over the GAI and try to shop options for indemnity?
Well, once their balance sheet is at a point to, kind of stand on its own, and what I mean by that is kind of overqualify for what they need in terms of surety credit, that's when we can start negotiating out of personal or spousal indemnity provisions. But, we usually have an annual surety meeting, and it's almost every time that topic comes up. And that topic comes up, hey, I don't want to sign personally anymore. What do I need to do to get off of it? And then we give them, a path essentially to start looking at removing that. Frankly, now in the industry, a lot of sureties are doing, homestead waivers where they're at least, getting off of the personal residence, or they're looking at limited indemnity, and then, kind of eventually transition to just a solely corporate indemnity.
Yeah, and that's something I think all companies need to consider, and often they don't have a company that, as their broker, that's experienced in this market enough to know kind of what these risks are and the upsides for removing people off of the indemnity agreement. And they realize, okay, I have bonding capacity. I've been using the same company for years. Let's just stay with them. And 10, 15 years go by, and the people that are on the indemnity agreement are either no longer with the company, have moved on, or there's really no reason for keeping them on the GAI at this point in time, but they never revisited it. So now a bond claim is made, and all of a sudden they're on the hook personally. So I think that's something that's very important for all contractors and subcontractors to think about, at a minimum every year, because it can be devastating. So a default, some more surety terms for you. That's the event that triggers the claim on the bond. So examples of that is when the subcontractor says, I haven't been paid. Surety, you issued a payment bond claim, pay me. Or the government saying, the contractor's way past schedule, I'm going to terminate. Those are all events of defaults. The penal sum, that is the maximum amount that the surety is required to pay under the bond. Usually it is the contract price, but the surety will not be liable for more than the penal sum. So if you run into a case where it's a $100 million project, but the project is a year and a half behind, and now with liquidated damages, it's going to cost $150 million, the surety is still going to be responsible for solely the 100. And where does all this come from? That's the Miller Act. So the Federal Miller Act requires contractors to post bonds guaranteeing their performance, and many states have their own Little Miller Acts, which also require the posting of payment and performance bonds. Next slide. So insurance versus surety. This is one of the areas where we see the most confusion. And often we find that either the contracting officers or the owners aren't really familiar with what a surety bond is supposed to do. So a surety bond, while it is a form of insurance, it is not an insurance policy. An insurance policy is a contract between the insured and the carrier. There's no requirement for reimbursement in the event of a loss. You pay your deductible and essentially, move on. Whereas in a surety, there's a three-party contract between the owner, the surety, and the general contractor, and the bond guarantees the performance. It's essentially a extension of credit or letter of credit saying that my principals are going to do what they need to do, and if they don't, I'm going to step in and make the situation right. And once that has happened, principal, you are going to have to refund me for any amounts that are expended. So a surety can't just pay and move on. There isn't, let's just do a simple settlement, because the surety under the terms of the bond is going to be looking for that compensation back from the principal. So the surety has to conduct an investigation, and any payment that is made has to be justified, because often they will seek recoupment. Next slide. So this slide just shows the relationships between the surety, the obligee, which we mentioned was the government or the private owner, and the prime contractor, or you can also use the prime contractor, the subcontractor, and the surety, depending on which level you are in the chain flowing down. But this just shows the relationship between the parties, and that it is a three-party agreement. Next slide. Now this slide shows the potential surety bond claims and where these claims can come from. So the owner can make a claim against the general, or the subcontractors can make a claim against the general. So claims flow down and flow up. There's also the arrows to the side which show which surety bonds claims can be made on, and how those claims would be made, and what general agreement of indemnity would be triggered there. Next slide. So as Josh mentioned earlier, On the Defense Environmental Restoration Program, this is essentially the Superfunds. These are sites that have been contaminated. We're talking about unexploded ordnance, where there's a significant cleanup. And on these types of claims, the surety is going to step into the shoes of the contractor and will be responsible for the cleanup, but is not responsible for personal injury or property damage. And again, the surety has the benefit of the penal sum, so would not be liable for any funds exceeding the penal sum of the bond. And as in all claims, whether it's under the Defense Environmental Restoration Program or the Miller Act, the surety gets the defenses of the contractor or the subcontractor, their bonded party. So whatever claims and defenses that bonded party has, the surety likewise has. Next slide. So there are other insurance provisions in Part 228. The risk pooling arrangements, this is a mechanism that the federal government has to try to save costs. Because, as Josh mentioned earlier, these costs are being invoiced back to the government. So how can the government save? And we have the risk pooling arrangements. They provide for general liability, aircraft, workers' comp, and vessel protections. The Defense Department Group Term Insurance Plan. Next slide. War hazard losses and capture, detention, mishap reporting, and ground and flight. Some of these are waivable, and in order to secure waivers, you have to go through the office handling the contract, and there are specific items that you must include in your waiver, such as the nationality of your employees, the reason for the waiver, the name of your insurance provider that provides Defense Space Act coverage, the location of the performance, and general information about that contract. So the name and address of the contractor, your contract award number, date of award, those types of things the government's going to be looking for from you. Next slide. And that concludes my presentation. I hope that this has been a beneficial and learning process for all of you, and feel free to reach out if you have any questions. And Josh, thanks for presenting with me today. It was a great experience.
Thank you. Same here.
Yeah, thank you to you both. And please definitely reach out with any questions you may have with the contact information on the screen right now. And thank you, Josh and Susan, for a great presentation and for sharing your time with us today. And thank you to everyone who joined us for this webinar. The recording will be on our website and YouTube channel within the next 24 hours. And please join us next week as we cover more parts of the DFARS. Have a good one, everyone.
Thank you.
Thank you.